The Fed meets again this coming week. There are some who believe it should pause cutting interest rates this time. One of them is wealth manager Cameron Dawson. Here she is recently on Fox Business.
So if the Fed continues to cut rates a lot, it could be like throwing lighter fluid on a fire that's already burning.
Now, what is the upside for your clients if the Fed does slow down this year, or the downside if they stay aggressive and continue to cut rates to try and control inflation?
When the Fed cuts rates, that generally creates an environment where the stock market can perform at a very high level. Now, the wild card with all of this is we have a new administration that's taken office. Mm-hmm. This administration, in my view, appears to be pro-growth and pro-business oriented. So that's certainly a good thing. So I would say that I would be talking to my clients about maintaining a level of risk that allows them to take advantage of the market as long as the Fed keeps cutting the rates. Because interest rates are going to drop, which then will create a scenario where more of the risk on trade makes sense for people. So looking at some of the models that we have here, like our blue chip income, that gives people a lot of exposure to growth, but it also has an element of income and safety built right into that portfolio. I also think this all-weather portfolio could have some implications for people who want to take a piece of their portfolio and protect it in the event that the Fed does not continue to cut rates. But as long as the Fed is trying to promote growth because inflation is under control, I think that's really, I don't want to necessarily say a green light, but it's a light green light for investors who are still in an accumulation mode to take the risk on trade and to try to use that to grow their portfolio.
You know, when I'm thinking about what to invest in when the Fed cuts interest rates, I would agree with a lot of what you said in the fact that, you know, the longer the time frame that you have, the more equity-based investments can benefit long-term investors. You know, for those of you that are within 5 years of retirement or you're already retired, what I would recommend that you do is I would recommend that you go online and Google the independent income system, and you can watch the video that, you know, is our methodology and philosophy that talks to you a little bit about, you know, how to think about your retirement plan and what your investments are and how to position those investments based upon the goals and objectives that you have. Because, you know, watching the news of what interest rates happen and changes make this month and shifting your major moves in your portfolio, you know, can be kind of costly, if you will, when you're just chasing some of the short-term noise overall. What I do like is I like the fact that, you know, if you look at things historically speaking in a non-crisis environment, which is what we're in right now, when the Federal Reserve cuts interest rates, that historically has been positive for equity returns. We also have to take into consideration the two strong back-to-back years that we just finished off in the equities market. I think I've shared this story on our podcast and on our YouTube channel and on radio before, but I had met with a gentleman, probably 2.5, 3 years ago, just a little bit after COVID. And what he decided to do is get out of the market because he didn't feel comfortable with the administration and was going to wait until now there's a new presidency in place. And by sitting out of the market, he missed, some massive moves as all. So, here he could be sitting in a money market account. The positive thing about money market accounts is interest rates went up. Money market accounts paid, great levels for quite some time. Those rates have come down. And so now is he going to get out of the cash and move into the stock market after these two back-to-back years? So even though I'm optimistic about equities, to me that would be a dramatic shift in his risk level as well. Bonds, on the other hand, as we see money market rates come down, bonds historically, perform well when you have the Fed cutting interest rates. Bonds in a lot of particular cases, haven't necessarily fully recovered from some of the declines that we saw when interest rates are going down. So if you wanted to stick to more of a similar kind of risk level and go from one fixed income to the other, that could be an option for you as well. There's things like fixed annuities that traditionally will offer a higher rate for longer than what you could get on traditional other fixed income vehicles that are out there. Real estate, whether you're, as we were talking about in an earlier section, whether you're looking to invest in, real estate personally, or whether you're looking to buy, publicly traded real estate, as my son is experiencing as he's shopping for his first house, he loves lower rates right now. So he's just hoping, rates keep going down. So there are different asset classes. There's different things to take a look at. And again, it just comes down to your own individual goals and objectives. And so if you're not sure how to invest when the Fed cuts rates, give our office a call. We can do that independent portfolio analysis and help you take a sniper shot approach into how to invest for 2025.
Threats and opportunities is a common theme here on the show. It's the topic of workshops that the team at America's Retirement Headquarters does. And truth be told, any given situation is both a threat and opportunity, depending on how you're looking at it. When it comes to interest rates, very much so. In the case of your son Nolan, lower interest rates, great time to go house hunting, but maybe not the best time to use those vehicles that are tied to interest rates. Finding the right thing that's going to work for you. Again, the independent portfolio analysis can go a long way towards doing that. All you need to do to get started is reach out, set up a time to speak with America's Retirement Headquarters. You can go to arhq.com. or give a call, 419-794-3030.